Breaking news, and we are watching the markets incredibly closely. It is a rough and jittery day, and just how jittery, look on your screen. This is the volatility index, the fear index, super red hot. It is climbing 24 2/3%. As we look at the volatility index intraday, you can see it was kind of fine in the morning and certainly calm yesterday, but the spike began on a couple of things. Stocks started to fall on the confusion about whether the trade truce really is clear and set, and also how the bond market was behaving in a very bizarre way. We bring in our next guest who knows all things bonds and stocks. Top financial CEO with more than 35 years experience in the financial sector, 11 million clients, trillions in assets. He places stock orders super quickly. We welcome TD Ameritrade CEO Tim Hockey in a Fox Business exclusive. How many people are trading? I mean, I'm sure you're getting the updates as we speak.
It's a big day.
Are they buying? What are they doing? Panic or calm?
No, I don't think it's panic. As you noticed, the VIX has actually spiked later on in the day. It was a relatively slow start.
Yeah.
We'll probably do about 1 million trades today, which is a big number.
What's your record?
Our record is about 1.5, and average, I would say, this past year was, call it 750 to 850 around there. So it's a big day, but it's not a crazy day.
So there's a headline. I mean, you'll do about 1 million trades today alone.
Yeah, but tomorrow the markets are closed, so it'll be zero.
Yeah,
so it averages out to 500,000.
Okay.
The VIX, on the other hand, I always smile when I see this, and you're right, the climb in the intraday was a big spike, but 20 is the long-term average. And so we've just become used to a relatively low, in fact, ultra low, you could argue, VIX level over the last few years. And it's only recently now that we're starting to see it get up to even just average for the long term.
You've got 11 million clients, I'm sure. Let's just say a good 1/3 of them even, if they are very concerned about what they're seeing, with the Dow down 740 points, all major indices selling off. You as a CEO are watching in two different ways. One is the CEO of a publicly traded company that likes higher rates, I would imagine. I mean, Fred Tomczak used to sit here, Joe Mowgli, all the previous CEOs, right. And they said, we like higher, obviously, because then you get to be able to bring in more money with the money that's parked there. But as you look at this yield curve, the inversion between the 2 and the 5, sometimes in the past that has signified a recession is coming. Right. Is it?
Well, depending on who you listen to. As you know, it's a very good indicator. It's not a perfect indicator, but I think the difference in elapsed time between when it inverts and when you actually get the recession is interesting to know. It actually ends up being, on average, almost 2 years. And so from the point of inversion to the actual peak in, call it, in the markets, could be, on average, over the last 20 or 30 years, a couple of years.
Inversion between the 3 and the 5,
or the 2 and the 10. Or
so does one have more weight than the other? Everybody talks about the 2 and the 10.
That I couldn't tell you. I think that fact, I think it relates to the 2 and 10, so you could argue maybe we're not even there yet. So the point is, it's been this inexorable slide in the gap over the last little while.
Okay, so everybody, we might have 2 years of breathing room here.
Could, right?
But looking at the stock market now, let's flip it over to equities. Are you hearing from a lot of clients right now?
Sure. Well, we have two businesses. And so the way to think of it is we have our retail business, those 11 million clients that are actively empowered. They're thinking about their own trading and making their own choices. Mm-hmm. They actually see these types of opportunities because they're quite savvy investors and they actually buy into those tips. So we often see net buying behavior on days like today. Our other business is our institutional business, where we serve as a custody for our RIAs.
Yeah.
And the clients that actually work for the RIAs look at these types of days and they actually say, ooh, I'm a little bit more nervous, because they tend to want to work with an advisor, so they might not be as savvy about markets ups and downs.
I think
our retail investors actually enjoy this because they like trading.
Okay. I think
enjoy might be strong. They'd rather see it when they had days like yesterday when it's up.
Some of them have a little spilchas right now, a little heartburn. Tell me, as we're looking at the NASDAQ down triple digits, and this is a pretty significant move. I think I know the answer to this next question, but I want to hear it from you. What matters more? What should matter more to all of your customers? The trade situation and the confusion there, or what the Fed does?
By far, the Fed decision in the long term is way more important to the fundamental drivers of the economy. The reason why we're seeing so much up and down activity, notably around the trade file, is because it can go from, hey, everything's all clear, to the next instant a tweet comes out and maybe it's not clear. So global trade is a hugely important issue to the economy. But the intraday volatility you're getting based on a shift in mood or a meeting is way less important than the absolute direction of interest rates over the long term. And this is
where do you see them in the long term?
Well, as we've just been seeing, the
right?
question is, they have been going up. The question is, how much more can they go up?
Well, with this and the concerns about trade, the slowdown in housing, GDP is slowing down.
Record low unemployment rates.
Okay, that is the good part, but also...
No, well, again, you have to think about, it's certainly nice to have record low unemployment rates, but the question for the economy in the future is how much further can they go? And there's just not a lot of upside to have even more and greater unemployment
but
decreases.
Also a worker shortage,
right.
too.
And so that drives wage pressure, which drives inflation, which drives interest rates to counter. So when you get to these levels, you are seeing what you would expect to see after about 10 years, which is we're getting to that frothy end of the cycle.
Is it a mistake for the Fed to raise in the next couple of days? It's got a meeting.
Not my job to. They've got much more views into the crystal ball to say. But I would think that they have been prudent in raising appropriately, and these intraday fear, greed shifts, depending on how many news items comes out on the day, shouldn't impact them. They should be focused on the multitude of data that they have available to them.
As busy a day as it is with your 11 million clients, did you think about canceling with us? Because no way, right?
No, my team is more than capable of handling the volumes, and they're doing a great job and standing by our clients, and lots of opportunities. So happy to be here.
That's what we really needed to hear. Thank you so much.
Thanks
Tim Hockey is the CEO of TD Ameritrade. Thank you. Please come again.
I will.